and there are advantages. So the whole life insurance, it generates cash value. Universal generates cash value per se. And then you have the variable universal. It again generates cash value per se. Okay, and they are tied up to these interest rates in the markets and whatsoever. So, is there an advantage of getting a whole life policy rather than UL or universal life or variable, or vice versa, or how do you determine this?
It really, Gary, it really depends on the situation, and that's where a financial planning approach is probably the best way, a needs-based planning approach, whether it's for a business owner or whether it's for an individual and their family. To determine which product is going to accomplish the most. You may even use a combination of the products in a given situation. Term insurance is known because it's known for being very inexpensive. And you have term insurance that is yearly renewable, could be 5-year term, 10-year, 20, 30-year term. And the idea is that you're covering a fixed exposure that you have from a risk standpoint. Term insurance is probably the best thing that's in sliced bread for the insurance companies because people pay premiums and only 1% or 2% of the death benefits are ever paid in claims because people don't die during the term period. Many times that's why it's important to maybe have that to max out the risk exposure coverage, but the other more permanent vehicles that cost a little bit more in terms of funding may provide some equity over a period of time and actually become a better buy in terms of your life insurance need. As long as you're living longer and you're paying into those contracts, over time they may perform very well, and they may create some cash value for you that you can use for other purposes during your lifetime.
What may they be?
Child's education. You may have to draw down money that you need for the business from time to time. During the Depression, when the banks were closing, life insurance were loaning money from cash value life insurance policies to the insureds. And that kept many businesses alive and the doors open. People don't think about those things. The whole life is a traditional life insurance policy. They always refer to it as the black box because the mortality charges and the expenses and everything's done internally inside the policy. We basically say at your age, here's the premium, and we will insure that to that death benefit for as long as you live. And that policy will be forever. That's why they call it whole life. Universal life is, as Brian said, is an interest-sensitive product that is a portfolio rate declared by the insurance company based on their investments, expenses, etc. And then the variable life product is, but there's risk to you by having that policy because the mortality charges go up every year. They strip it out, they spell everything out in terms of your expenses, but you have more exposure. You want to transfer the risk to the insurance company, you go with the whole life. If you want to share the risk, you go with universal or variable. And the variable, of course, you're selecting investments, and hopefully those investments help the product perform over time.
So in reality, there is no good policy like term policy. You can't just say term policy is a better policy than cash value, whatever. Everything has its own purpose in your life, and you actually need to talk to someone who knows what he's doing, structuring your policies, rather than just buying it off the street for leaving some money for your final expenses or something else, right?
Absolutely right.
And Gary, I think an important thing there is a lot of people say, okay, well, my neighbor, has a similar car that I do. They live in a similar house. They have 2 kids just like I do, and they bought term insurance, or they bought universal life, or they bought whole life, and they bought however much, $500,000 or $1 million. That's what I should get. You need to really sit down, and it is an individual case-by-case basis. You really need to sit down with a financial planner that's able to look at all your assets, able to look at all your needs. Again, those short-term needs, maybe mid-term needs, long-term needs. They take into account your budget and are able to fit something that works and makes sense for you.
Okay. So, as I always say, one size never fits all.
That's right.
In the financial world, as far as your financial planning goes, one size never fits all.